Thank you, Madison. I appreciate that. So, in today's briefing, we're going to cover global corporate venture capital investment activity as a whole. We'll then look at sector specific activity, and then we'll dig into geographic trends in Asia, in Europe, in the UK, and here in the US. And then finally, we'll look into activity in emerging verticals like artificial intelligence, cybersecurity, and digital health. At the very end of today's presentation, we'll leave some time for audience questions. But first, we're going to start with global activity. In 2018, CVC firms participated in nearly $53 billion of funding across more than 2,700 deals. This activity was nearly a third higher than in 2017 and nearly 50% higher in terms of total capital invested. Some of the largest deals throughout the year included a $2 billion round to trucking logistics company Manbang Group and a $1.5 billion Series D round to Indonesian mobility company Gojek, as well as a $900 billion round to travel and hospitality startup Oyo Rooms. But Oyo wasn't the only company to receive a $900 billion round in 2018. So if we jump over to CB Insights for a moment, we can run a deal search to look at all corporate venture capital activity over the last year. So in this search, we're going to pull in all equity rounds using our filters here. We're going to add a date filter running from January 1st, 2013 through year end 2018, and for investors on the right hand side, we're going to pull in corporate venture. So if we run this search in our chart view, we can see all corporate venture activity on an annual basis and also on a quarterly basis. This is also interactive, so we can dig into individual quarters here and analyze specific deal activity. We can also sort this table to rank by round size. And in Q4, we see that Southeast Asian mobility company Grab also raised a $900 million Series H. Grab was backed by Yamaha Motor Ventures in this particular round. And so if we jump back to our presentation, we see the increasing impact of that CVC has had on the overall venture ecosystem. In 2013, CVC investors participated in 23% of all VC-backed deal activity, which is an all-time high. We also see that corporate venture capital firms are involved in larger rounds of financing as well. The average deal size with CVC participation was about $4.5 million greater than the average VC deal size without VC participation. There are also more CVC firms investing for the first time. In 2018, we saw significant increase to the number of new CVC firms. There were nearly 70 more first-time corporate venture capital firms in 2018 than in 2017. And CVCs are also becoming more active at the earliest stages. In 2018, we saw 332 CVC firms investing at the seed stage and 419 CVC firms investing at the Series A stage. But these corporate venture arms aren't the only corporate entities investing in the startup ecosystem. As a matter of fact, we've seen direct corporate participation skyrocket in recent years. These are corporates investing directly from their balance sheets. In 2018, corporates participated in over 3,800 deals that did not include corporate venture participation. This was significantly higher than deals with corporate venture but not direct corporate participation. So now we'll look at some of the most active corporate venture investors in 2018. Google Ventures was once again the most active corporate venture investor. They backed over 70 unique startups throughout the year. Salesforce Ventures and Intel Capital followed close behind. New entrants to our top 10 list include Baidu Ventures, SBI Investment, Alexandria Venture Investments, Kakao Ventures, and Mitsubishi UFJ Capital. So a lot of participation from Asian-based CVCs. If we look at CVCs investing in unicorns during 2018, we see that And again, these are CVCs backing companies that have already exceeded $1 billion valuations. We see that Google investment arms rounded out the first two spots. That's Capital G, their later stage growth equity firm, and then Google Ventures. Dell Technology Capital, Legend Capital, Orange Digital Ventures, and Qualcomm Ventures all backed two unicorns during 2018 as well. So now we'll jump into some sector-specific activity. We saw an all-time high CVC participation in the internet sector, reaching nearly 1,200 deals and over $21 billion of investment. The spike in invested capital was the result of a number of late-stage mega rounds to companies like Gojek, Grab, and others that we mentioned earlier. Mobile is also reaching all-time deal and dollar highs. It reached $9 billion in invested capital, over 415 total deals with CVC participation in 2018. Healthcare also saw a drastic increase of invested capital. CVCs participated in nearly 300 deals that contributed nearly $11 billion in total capital to the healthcare sector. Now we'll take a look at some geographic trends. We see that Asia is on the cusp of becoming the primary beneficiary of CVC investment. So CVC-backed deals to Asian companies made up 38% of global activity, whereas North American startups, primarily US startups, but North American startups attracted 41% of all CVC deals. Within Asia, we see that most CVC investment is pouring into China. Companies in the country benefited from the nearly $11 billion invested over 351 deals with CVC participation. In Japan, we also see significant growth, though the overall amount invested wasn't as significant, only $1.4 billion approximately. And in India, India also benefited from record activity. However, half of the $1.8 billion invested in 2018 was the result of that $900 million deal to Oyo Rooms, which we mentioned earlier in our presentation. Now, if we take a look at Europe and the UK, we see that European startups received record activity and funding from CVCs, reaching $5.5 billion over 468 deals. Notable startups raising in 2018 included AI chipmaker Graphcore and mobile banking apps N26 and Monzo. If we look at where this funding was distributed throughout Europe, it's quite diverse. Unsurprisingly, we see that the largest share is going to the UK, but we also see Germany and France receiving a good portion of deal activity as well. If we dig into the UK specifically, we see that the nation brought in more capital and more overall activity than any other year since 2016 at the very earliest. The largest deal in the year was a $200 million Series D to Graphcore, again an AI chip maker. Much of the activity in the UK is also happening at the earliest stages. Nearly 45% of overall activity considered early stage, and this includes seed investment and Series A financings. Now we'll look across the pond, back here in the US. We see that CVCs participated in over 1,000 deals, which contributed more than $26 billion in capital to US-based startups. California is the primary recipient of this capital, receiving over $14 billion across 509 deals. In New York, we saw a rebound in total funding though deal activity has remained relatively stagnant over the last 3 years. However, CVCs were more involved in backing companies in Massachusetts than ever before. Funding grew a staggering 76% from the year prior as well. So in our final section here, we'll look at CVC activity in emerging areas like AI, cybersecurity, and digital health. First, we'll jump into AI, which saw record deals and funding driven by more activity in Asia. CVCs participated in nearly 300 deals, which contributed more than $5 billion in capital to AI startups last year. North American and Asian companies are now competing neck and neck for CVC funding, and we may see Asian AI companies receive more CVC activity over the course of this year. Baidu Ventures, Google Ventures, M12, which is Microsoft's venture fund, Intel Capital, and SBI Investments were all the most active CVC investors in AI companies during 2018. Now to CVC activity in cybersecurity. We see that CVCs participated in 112 deals, which contributed more than $2 billion in capital to cybersecurity startups last year. We do see, however, that North American companies are still the primary benefactor of this CVC investment. And in a way, this makes sense. A lot of nations around the world might trust a U.S.-based cybersecurity product compared to that out of China or other countries in Asia. And we see that most of the most active investors, CVC investors in cybersecurity, are from North America. 4 out of the 5 CVC investors, North American based. And finally, we'll take a look into digital health, which, like AI, has seen increasing amounts of activity in Asia. With that said, despite record deal activity, we've seen total capital invested decline. This is the result of smaller average round sizes and fewer mega rounds as well, both tied together in some way. And again, we just see how close Asia is to becoming the primary benefactor of these CVC investment dollars. Like AI, we may see Asia overtake the US in 2019. We also see a very diverse set of investors, with Baidu Ventures and SBI Investment operating in Asia, while Google Ventures, GE, and Illumina Ventures operating here in the US. So that concludes our presentation for today. At this point, I'm going to open it up to some audience questions and hoping for some good ones. So we have a good question here about which companies, which CVCs might break into the list over the course of 2019. So for next year's report, I don't have a great answer for that. I don't have names of specific CVCs or corporates, but with all the investment that we're seeing in Asia, I would expect to see Asian CVCs, or at the very least CVCs investing in Asia. They may be US CVCs investing abroad, but I would expect to see those type of firms rise to the top of our most active list. And we saw that this year, right? I think it was half or over half of the CVCs on our top 10 most active investor list were based in Asia. So really the takeaway and theme of this presentation in general is just this story of rising dominance, at least within the corporate venture capital landscape within Asia. And I think when you look at the success of traditional VC firms like Sequoia Capital China, it wouldn't be surprising to see some of these big US tech firms start to establish dedicated region or country-focused investment arms. So that might be a trend that we run into in the future. Another question here about the rise of new CVCs investing for the first time. Is this a herding mentality? Is this a case of FOMO? And that's a really, really good question. I think the motivation for starting a CVC is two-sided, right? There's the competitor aspect of it. Well, actually, in a way, it's all about competitive strategy, right? On one hand, you have incumbents that you're competing with. On the other, you have these upstart emerging companies that are looking to compete with you as well. So I think between those, it's providing quite a bit of incentive for corporates today to start these CVC firms. I do think it is the result of a herding mentality in a way, right? No one wants to be the last one to establish that CVC firm. But again, the motivations are really around competing with their current competitors, those that are incumbents, and also sort of protecting themselves from these startup companies. If a startup comes along and is able to compete with them in some significant way, at the very least, they can have a financial stake in that success. Also, it's important to keep in mind that although we're seeing the growth of these new CVC firms, that doesn't necessarily mean that these are the first CVC firms of a company. Oftentimes, you see these major tech companies with 2, 3, even 4 CVC firms in total, all starting at different times with different focuses. Often focus around a specific vertical or technology. So it's important to keep that in mind as well. These could be the second or third or fourth firms of a lot of these corporations. Interesting question about areas where CVC might still be immature. I would say that industrials or very capital intensive spaces where a lot of infrastructure is required won't be attractive to CVCs at any point in the near future. And I think the same goes for VC, right? It sort of mimics the traditional VC landscape, but in these spaces, startups are less of a concern, right? They don't have the same resources or capital to compete with current incumbents. So the motivations to start a CVC, if you're one of these incumbents with a lot of market share, isn't as significant. You don't really have the concerns that these very agile and digital focused companies might. I think a good example. Well, actually, if you think of like GE Ventures or Verizon, GE focused on a lot of the energy infrastructure, Verizon on the telecom infrastructure. Although these are companies with CVC firms, most of the investments that these CVCs are making are focused around digital technologies or highly scalable technologies. Right? They're not investing in traditional telecom or traditional or even alternative energy companies and infrastructure, right? They're not as concerned about startups competing in that area. Question about CVCs being impacted by stock market downturn. Interesting question, and no question about it. Like any other investment firm, that there's going to be negative impacts to that, but I think it's interesting in that CVCs have this double-edged sword in that the tie to a corporate parent is both a benefit, but can also be a negative in ways. In one sense, it provides some security in that you have this LP that is committed to you and constantly providing capital. But on the other hand, if things turn south, it might be the case that the general partners of these CVCs have less control. They're more at the whim of decisions being made within that corporate parent. So again, without question, though, if there's a stock market downturn, everyone's affected by that. So without question. How do you see CVCs investing in a company? Do you see CVCs investing in a company and then having the corporates acquire them later on? You do see it. It's not terribly often, but you do see it. One company that comes to mind is Bonsai AI. Bonsai AI is a provider of an AI platform, and it allows businesses to build and deploy these machine learning systems. So I want to say that M12, again, that's the venture arm of Microsoft. I want to say that they backed Bonsai in 2017, may have been earlier, but then I think they bought it just a year later. It was a pretty short cycle between investment and acquisition. And again, that's just one example that comes to mind. You do see it, but again, it's not terribly prevalent either. What you do see more of, though, is competitors acquiring companies that their competitive CVC arms invested in. So you might see Microsoft, M12, Microsoft's venture arm, invest in a company, and then down the line you see a Google or an Amazon buy that company for their cloud services. So you see more of that than you do, direct CVCs investing and then their direct corporate parent acquiring that company. And then a question about CVCs investing for strategic or financial return. I don't have a great answer to this question. It's simply because you'd have to understand the individual motivations of each of these firms, and that's just a level of transparency that we don't have. With that said, each of these organizations should be investing for financial return first and foremost. If corporates are interested in experimenting to better understand the landscape or to, for research purposes, partner with companies, start incubators and accelerators, which, mind you, were not included in today's analysis. But there's really no need to start a CVC firm just to better understand the landscape. There are a number of different avenues and mediums to take before investing through a CVC arm. It's certainly great when there's overlap, with the strategic intentions of a corporate and the financial motivations of a CVC. But I think first and foremost for the CVC, it should be, financial returns. And again, that just sets the CVC up and then that corporate parent up for greater success. If that's the motivation of the CVC firm, more likely than not that it'll be a successful endeavor. I think that's it for today's questions. Wrapping up right around 1:30 here, but thank you again, and I'll pass it back to Madison.